Climate change is an undeniable reality, and it is affecting our planet in many ways. The growing recognition of this problem has led to an increasing demand for investments in sustainable and environmentally friendly projects. This has given rise to a new financial tool called green bonds, which have been gaining popularity in recent years. In this video, we will explore what green bonds are and how they are making a difference in climate finance. Welcome to this channel. Today, we will be taking a look at green bonds and climate finance. At the end of this video, you'll have a greater understanding of what green bonds and climate finance is all about, as well as how you can make a positive impact with your money. Before we continue, make sure you like and subscribe to stay up to date with our latest videos. What are green bonds? Green bonds are a type of fixed income security that are specifically designed to finance environmentally friendly projects. They are similar to traditional bonds in many ways, but the funds raised from green bonds are earmarked for projects that promote sustainability, reduce carbon emissions, and address climate change. In comparison to a comparable taxable bond, green bonds may offer tax benefits, including tax exemptions and tax credits, making them a more appealing investment. These tax benefits offer a financial incentive to address important social challenges like climate change and a shift toward renewable energy sources. A third party, such as the Climate Bond Standard Board, which verifies that the bond will finance initiatives that have a positive impact on the environment, is frequently consulted to confirm whether bonds will qualify as green bonds. Green bonds are typically issued by governments, corporations, and other organizations that are committed to sustainability. The proceeds from the sale of green bonds can be used to finance a variety of projects, including renewable energy, energy efficiency, clean transportation, sustainable agriculture, and water management. With $14.4 billion issued in green bonds from 2008 to 2020, the World Bank is a substantial green bond issuer. 111 projects have benefited from these funds, most of which are in the fields of sustainable transportation, renewable energy, and agriculture. The Rampur Hydropower Project, which planned to supply hydroelectric power to northern India's electrical system, was funded by one of the bank's first green issuances. The Rampur Hydropower Project generates roughly 2 megawatts annually, eliminating about 1.5 million tons of carbon emissions. Green bonds have been growing in popularity in recent years. According to the Climate Bonds Initiative, the global green bond market reached $257.7 billion in 2019, up from just $4 billion in 2010. This growth is being driven by a growing awareness of the need for sustainable investments, as well as increasing government and corporate commitments to reducing carbon emissions and promoting sustainability. The Climate Bonds Initiative estimates that $269.5 billion worth of green bonds were issued in 2020. With new issuances totaling $50 billion, the U.S. was the major participant. The total amount of green bonds issued had, according to the same estimate, exceeded $1 trillion. You should keep in mind that there are certain variations that have given rise to different types of green bonds. This simply means that even though all green bonds are a type of debt financing for environmental projects, each one's unique features might vary depending on the issuer, the purpose of the funds, and the bondholder's access to the assets of the issuer in the event of liquidation, among other things. A type of green bonds available on the market is the use of proceeds bonds. Although the purpose of these use of proceeds bonds is to finance green initiatives, lenders have access to the issuer's other assets in the event of a liquidation. The issuer's other bonds and these instruments both have the same credit rating. Another type of green bonds is the use of proceeds revenue bonds or asset-backed securities. With these instruments, green projects may be financed or refinanced. However, with these instruments, the collateral for the debt is obtained from revenue streams that the issuer collects, like taxes or fees. When issuing green bonds, state and local organizations could choose to use this kind of framework. Project bonds are also another type of green bonds. This kind of bond is specifically designed to fund a specific green project, which means that investors' liability is restricted to project-related assets. Securitization bonds, on the other hand, involve a collection of projects put into one loan portfolio, with bondholders having access to the assets supporting the entire collection of projects. Good examples of securitization bonds include solar leasing ventures and green mortgages. Covered bonds are a type of green bonds that involves providing funding for the covered pool, a collection of green projects. With covered bonds, investors can seek redress from the issuer, but if the issuer is unable to fulfill debt payments, bondholders gain access to the covered pool. Green project financing can be unsecured or secured. Secured financing refers to loans that are backed by collateral. With unsecured loans, lenders have complete access to the borrower's assets. In the case of secured loans, however, lenders have access to the collateral, or in some circumstances, partial access to the borrower. Now that we've taken a look at the various types of green bonds, let's discuss how you can buy green bonds for yourself. The usual investors in green bonds are institutional investors, groups like hedge funds, endowments, and mutual funds that can afford to put a lot of money into debt instruments. Yet there are several mutual funds and exchange-traded funds, or ETFs, that offer exposure to the green bond market for retail investors who seek to match their ecologic principles with their fixed income portfolios. The iShares USD Green Bond ETF, BGRN, for instance, aims to imitate the performance of an index made up of investment-grade bonds intended to support environmental projects. Although the ETF only invests in debt with a US dollar value, it holds bonds from both foreign and US-based issuers. Some investment platforms, such as Robinhood, offer green bonds as an investment option. This means that with this platform, you have the opportunity to invest in green bonds in the same way you would have invested in other items. While retail investors who want to acquire individual green bonds may encounter some additional challenges, ETFs like BRGN are easily accessible and can be purchased through an online brokerage platform or a brokerage account. Although your broker may let you invest in individual bonds, you may be required to make minimum deposits and pay commissions if you choose to purchase green bonds from corporate issuers. You may be able to buy government-issued green bonds from the government organization itself or through your broker. With all this information on green bonds, you may be left wondering, how do green bonds work? Green bonds are issued by companies or governments, just like traditional bonds. However, the proceeds from the sale of green bonds are earmarked for specific environmental-friendly projects. This means that investors who buy green bonds are investing in projects that have a positive impact on the environment. The issuer of a green bond must specify the use of the proceeds, and there are various standards and certifications that can be used to verify that the projects meet specific sustainability criteria. For example, the Climate Bond Standard is an international certification scheme that ensures that green bonds finance projects that contribute to a low-carbon and climate-resilient economy. It is important to note the distinction between blue bonds and green bonds. Blue bonds, also known as sustainability bonds, are used to fund projects that save the ocean and its surrounding ecosystems. This can involve initiatives to promote sustainable fisheries, save delicate habitats like coral reefs, or lessen pollution and acidification. This means that while all blue bonds are green bonds, not all green bonds can be classified as blue bonds. It is also important to understand how green bonds differ from climate bonds. Although the terms green bonds and climate bonds are occasionally used synonymously, some authorities reserve the latter term for initiatives that aim to lessen carbon emissions or mitigate the effects of climate change. An organization called the Climate Bonds Initiative is working to create criteria for validating climate bonds. Green bonds offer several benefits for investors, issuers, and the environment. For investors, green bonds offer an opportunity to invest in sustainable projects that have a positive impact on the environment. These investments can also provide a good return, as green bonds are often issued by high-quality issuers with strong credit ratings. For issuers, green bonds can be an effective way to raise capital for sustainable projects, while also demonstrating their commitment to sustainability. This can help them attract socially responsible investors and enhance their reputation. For the environment, green bonds offer a way to finance projects that promote sustainability, reduce carbon emissions, and address climate change. This can help to accelerate the transition to a low-carbon economy and mitigate the impacts of climate change. Despite the many benefits of green bonds, there are also several challenges that need to be addressed. One of the biggest challenges is the lack of standardization in the market. There are currently no universal standards for what qualifies as a green bond, and different organizations use different criteria for certifying green bonds. This can make it difficult for investors to determine which bonds are truly sustainable and can lead to accusations of greenwashing. Debt instruments may occasionally be promoted to investors as green, even though their environmental benefits are, at best, questionable. Such instances of greenwashing, which involves making inflated or false environmental claims, emphasize the need for investors to conduct due diligence before making potential green bond purchases. Another challenge is the lack of transparency in the market. Some issuers may not provide enough information about the projects that are being financed by green bonds, making it difficult for investors to evaluate the environmental impact of their investment. Finally, there is a risk that the green bond market could become over-reliant on a few large issuers, which could lead to concentration risk for investors. To mitigate this risk, it is important to promote a diverse range of issuers and projects. Green bonds are debt instruments intended to fund eco-friendly enterprises. When compared to other equivalent forms of bonds, green bonds may provide tax benefits that provide incentives for funding sustainable initiatives. Green bonds offer an exciting opportunity for investors to support sustainable projects and make a positive impact on the environment. Investors looking for investments that support their environmental principles should make sure to check the sustainability claims made by bond issuers before investing in bonds. Thanks for watching. Feel free to share your thoughts in the comments, and please do not forget to like the video and subscribe to the channel. Thanks again, and we'll see you in the next video.